have what you call income or wealth concentration. That's a massive risk because you're under diversified. I was thinking about this as I was earlier on my Instagram. I mentioned something about Tyler Perry being sued again. Apparently, he's got some shenanigans happening in his life. I don't know what the deal is, but he keeps getting sued by all these dudes who claim that he's been grabbing their junk and stuff. And I don't know what happened there one way or the other. I told you I met Tyler once. He called me out of the blue. Sometimes people will just but just like when Kanye called, I was like, "Why are you calling me? I'm nobody." And so he called me, and he's very nice. And we talked about Medea and money and everything else. And I got a really good tour of his studio, and I was really impressed with everything he built. And the thing was though, I think that there's something happening there that's going to put his wealth at risk. He's got a couple of big ugly lawsuits. One's for $250 million. The other one's 77 million. He's got some other stuff happening. And one of the things that comes up with Tyler Perry is that I don't know how his money's diversified, but he appears to have some concentration risk and reputation risk, meaning that a lot of times in business you get deals done because you have a certain reputation and people accuse you of something even if it's not true. That reduces your economic value, and then also the concentration risk is all this wealth is sort of locked into one personality. Him and Medea control this billion-dollar empire, and if one of them falls off, then that could really affect their wealth. So ultimately, having side hustles or diverse streams of income or diverse places, diverse representations in your portfolio really goes a long way in protecting your wealth. Next, have you set up automatic investing? Automatic investing, quickest way to build wealth. All that is an annuity. All that is a consistent amount of money being put into a place that's going to allow it to grow over time. This is David Bach in his book, The Automatic Millionaire. That's what he talks about. All he basically talks about is annuities. And he basically says if you take, I think he calls it the latte factor, but I called it the $1 million Happy Meal. Other people probably have some other name for it. And all it says is like a little magic trick that just says, if you just put $5 or $10 a day into a stock portfolio and you do that consistently over 30 years, then when you're done, you will be rich. You're going to have $1 million by the time you retire. And but to me, that's not the half of it though, because if you have somebody that does that for you when you're a baby, then you don't have $1 million. You have several $1 million because you're getting 20 extra years of investing, 25 extra years that most people don't get. He's assuming that you start at 25 and go to 65. But because we're black and excellent, we go above and beyond. Our goal is not to be equal. Our goal is to be better. So being better doesn't mean I start at 25 and as if and started with nothing. The goal is that I start at the age of -5 because I got a parent that loves me and says, I'm gonna have a baby in 5 years. I'm gonna start investing for that child when they're -5 years old. So they're gonna have 30 extra years in addition to the 30 years David Bach talks about. Do you understand when I tell you that that is a financial tsunami that you're building? Like that is a financial tidal wave. That is so much wealth that it just compound interest is the craziest, most ridiculous thing in the world. One day I got to show you all a chart of how Warren Buffett turned a $150 investment into like an amount that's going to be like, I think it's going to be $6 million by the year 2030. He started in 1942. He's held this little mutual fund since the 40s. And you look at the chart, the chart's an amazing thing to look at because in the 40s, it doesn't grow very much. 50s, it doesn't grow very much. 60s doesn't grow very much. 70s, yeah, and you would be looking at this and thinking, okay, this is stupid. This is never going to be much money. And then something just suddenly happens where it hits almost like this. I don't know if you call it an apex or not apex. It just hits like this kink in the curve. Convexity in mathematics, they call this convexity. It's like you hit this inflection point. Maybe that's the term I'm looking for. You hit this inflection point where suddenly it's like kaboom. Suddenly the compound interest just grows and grows and grows. So money actually grows the way a virus spreads. If you think about how a virus spreads, if one person has it, then two or three people have it, then 50, maybe 100, then it's contained in one town. But why do they hurry up and contain it if it's in one city? They do that because they know that if it gets out of the city and goes too far, within a week or so, it's going to be all over the country, right? So money grows kind of in the same way. All right, next.